So what happened today? I mean, yes, I'm sure everybody's heard about this plague that's going on called COVID-19. This is what we call a black swan event. Why a black swan, you might ask? It means it's an event that nobody saw coming, right? And it hit us and hit the rest of the world quite surprisingly. Nobody really got to prepare for this. The economic impact of this, we still have to be able to realize what type of damage is going to do and how long. Is it going to be something experienced in the short, medium, or even long term? And because of all those questions, markets have been saying, look, I don't know how to be able to deal with this. So many people have been selling their positions, and that's quite, that pushed markets down quite strongly. And that's why you've been seeing a lot of even very, very ridiculous types of declines, some of which are probably forcing prices way below what their fundamental values are. And not because they're supposed to be there, but only because investors need to be able to generate a handle on safety for their investments. And they've just sold it to raise some cash because they don't know what to expect from these conditions. I guess the questions everyone's is really asking is, how long will this last? And if it doesn't last too long, then this opportunity that the market is showing us right now should be something that we should really try to take advantage of. Also, it's quite possible along this period of waiting we're doing, somebody out there will come out with a particular cure. And even if that cure perhaps is not disseminated a lot around the world immediately, the mere fact that everybody knows that a cure is finally in existence would probably be sending your market way much higher already. So in these conditions, you have to be ready, and you cannot just say that, I'll just wait for all these things to blow over and see what I'm going to do. Because if you do that, the opportunity of a lot of the discounts you're seeing may no longer be there. Now let's begin first with what happened with markets. You can see the slide that I'm showing you here. You can see it doesn't really matter where you're from, but all markets around the world did pull back. It's quite surprisingly, though, that the place where this all started didn't pull back as much as the rest of the world. But it could be because the Shanghai index have been actually falling down for quite some time already, and this is the reason why perhaps that they have not been experiencing this. Also, it's only now that the acceleration for the rest of the world is actually starting to be able to show itself and Shanghai's index is probably responding to the fact that we've already seen maybe 2 or 3 months of this exposure, and their market seems to be getting used to the idea that this exists and that perhaps the case is not accelerating anymore, and that's why perhaps the Shanghai index seems to be a bit more resilient than the rest. But the situation elsewhere is quite dire for markets. The PSEI has fallen, to a degree just this year. For this year, is about 40%. Even the MSCI World Index, which looks at the basket of many different indices, ex the US, is also down quite a bit. So given that we're all in the same boat here and everybody's still trying to play catch up with the situation, let's try to have a look at what particular things happen with the other markets as well. So on the left-hand side, you probably see the S&P 500. I've looked at data here since almost maybe 11, 12 years ago. And the reason I looked at that time frame is really because this is when the bull market began. So if you can see the utmost low point that you have over here, this is the 2009 low that we saw in the S&P, and that market just went practically straight up to almost the high that we've seen sometime actually this year as well. And after that, it just went vertical into a nosedive. Now, it's hitting its first Fibonacci support level closer to 38.2%. So it's quite possible that maybe we could probably be seeing an interim rebound for the US quite soon, if not already. We've also noticed that the US is also now implementing a lot more reforms and stimulus packages. And I think last night they just even announced that it's become open-ended, and they say they're going to do anything to try to be able to shore up this economic situation. So it might be a good time to be able to experience some type of rebound in reaction to these types of stimulus that the entire world is doing as well. On the right, you can see the German DAX. Now, the German DAX is showing you the conditions that were pretty similar to what happened to the US as well. And if you probably look at it, it's actually fallen much more than what the S&P had done. It's already coming close to almost having a 50% pullback of the rally that it made from 2009 to where we are today. So given the context of that, it might also be encountering some degree of support soon. But this might also some rallies for the meantime, but it doesn't mean that the decline is ending. This could just mean that markets have been extremely oversold and they may need to be able to do for some sort of counter rally for the moment. Looking into US bond yields and the dollar. Now, why do we look at bond yields? Bond yields tend to represent the opinion of investors towards interest rates. So if you see what's happening here, you see bond yields are falling down quite steeply. You actually can't see on the left side, but what you're actually seeing is that bond yields have gone down to an all-time low. And to the degree that we're standing below 1% right now. And I've looked back in my data since 1960 and 1950, and I've never seen bond yields that low. So it's just trying to be able to tell you how frightened the investor is out there, that they feel that perhaps more rate cuts will probably be likely to try to be able to generate more stimulus. And this bond yield is moving quite forward in terms of that anticipated move. The dollar has actually taken a very strong command of prices recently. Although there was a time where it looked like it was about to correct somewhere over here, but then the US dollar index just jumped up very, very strongly. If you're probably wondering what's going on in the US that managed to do this? Well, in reality, what you're looking at here is a US dollar that is strong because all the currencies that trade against it are actually weaker, particularly the euro. And so when the euro is actually weakening faster than the US, then you will still see a very strong involvement in the US dollar like the way it is. So it's really what you're seeing is that you're seeing a lot more weakness in other currencies. And that's the reason why the dollar has been relatively strong compared to the rest. Oil prices. If you look at oil prices here on the left side, it looks like quite similar to what bond yields are also showing you. Oil is falling down because people are quite worried that businesses may get disrupted and that the demand for oil may substantially fall down in the course of this activity. In fact, it's fallen already close to about $25 per barrel. And given the context of this particular decline, again, it's also showing you the anxiety that the situation that is being shown by everybody else. And here on the right side, we have gold. The gold seems to be the only commodity that seems to have been on an up move during this entire recovery. Yes, recently we've seen it pull back a little bit, but perhaps because it went up quite sharply from 1,300 all the way to almost 1,600, but still showing a general up advance. This could be because people are probably worried about all the other volatility they're seeing in other currencies, and they're trying to weigh out that gold may be a more stable thing to be able to hang on to during this period where there's a lot of unrest and instability for other markets. So I think that gold might decide to probably cascade more. But collectively, all these signals that we're looking at is still telling us that the markets are quite worried about things. Now, are we exaggerating things already? Perhaps it is. And because of that, we hope that in the short term that we could see some degree of rallies to be able to interrupt all these declines that we're doing. And they should be able to offer some degree of possible short-term trading for some traders as well.